YieldMax is rewriting the rules of income investing in 2025. With a lineup of ETFs promising high payouts and innovative strategies, they're catching the attention of everyone from casual traders to professional portfolio managers. In this video, we're taking a deep dive into their 5 newest funds: SLTY, RNTY, RBLY, DRAY, BRKC, to see how they work, what they've paid so far, and whether they belong in your portfolio. So what exactly is a YieldMax ETF? In simple terms, these are income-focused funds that generate cash by selling options, often covered calls, on popular stocks or baskets of stocks. Think of it like renting out your stocks to earn extra income. The strategy is appealing because it allows investors to capture consistent yield without having to actively trade options themselves. The trade-off, though, is that your growth potential is limited. If the underlying stock rallies, your upside is capped, and a big chunk of your distributions may actually be return of capital, essentially giving you back your own money. Compared to other income ETFs like JEPI or QYLD, YieldMax has carved out a niche by focusing on single stock strategies and creative income models. This makes their funds riskier and more complex, but also potentially more rewarding for investors who understand the mechanics. Let's start with SLTY, the YieldMax Ultra Short Option Income Strategy ETF, launched in August 2025. SLTY is unique because it takes inverse exposure to a basket of U.S. equities while simultaneously selling options for income. In simple terms, it's designed to make money when the market drops and generate weekly income distributions along the way. So far, its price performance has been flat, but it has delivered steady payouts. This ETF isn't for everyone. It's best suited for sophisticated investors who want inverse exposure with income potential and understand the risks of leverage and timing. Next is RNTY, the Target 12 Real Estate Option Income ETF, launched in April 2025. This fund aims for a 12% annualized yield by selling covered calls on real estate holdings. Year to date, it's delivered a distribution rate close to that 12% target, but nearly all of it has been return of capital rather than true income. Its price appreciation has been under 5%, while the S&P 500 has surged over 20% this year. RNTY may be attractive if you want to diversify your income sources beyond tech stocks, but you need to be comfortable with the possibility of principal erosion over time. Then we have RBLY, launched in July 2025. This fund writes covered calls on Roblox stock, a popular growth company in the gaming sector. It's an interesting idea, monetizing the volatility of a high-profile stock while generating consistent income. The flip side is that if Roblox stock skyrockets, your gains will be capped. It's a niche tool that could appeal to investors who believe in Roblox's long-term potential but want some immediate cash flow. DRAY takes the same approach but applies it to DraftKings, a leader in sports betting. Like RBLY, DRAY is still new, so there's limited performance history. But the strategy is straightforward: generate yield from a volatile stock that people already know and follow. If DraftKings stays flat or moderately up, you'll still collect those option premiums, but don't expect to fully participate in a sharp rally. Finally, there's BRKC, YieldMax's Berkshire Hathaway Option Income ETF, launched in June 2025. This one is particularly fascinating because it applies the income strategy to one of the most iconic names in investing, Berkshire Hathaway. BRKC currently offers a distribution rate around 16%, though roughly 81% of that is return of capital. Its net asset value is down about 2.7% year to date, while the S&P 500 is up over 6% in the same period. For fans of Warren Buffett who want steady income, BRKC is intriguing, but it's not a substitute for buying Berkshire stock outright if your goal is long-term growth. Now let's talk comparisons because context matters. The two big players in the covered call income ETF world are JEPI and QYLD. JEPI, the JP Morgan Equity Premium Income ETF, has a trailing 12-month yield around 8% and is known for its relative stability and moderate growth. QYLD, on the other hand, boasts yields north of 12%, but it's much more volatile and has seen price erosion over time. So where does YieldMax fit in? Think of it as a more aggressive cousin. Higher income potential, but with more complexity and a bigger risk of principal erosion. If JEPI is like a reliable family car, and QYLD is a sports car that requires maintenance, YieldMax is the high-performance track car. Thrilling if you know how to handle it, but dangerous if you don't. Understanding return of capital is key here. When you see a high distribution rate, say 15% or more, it's tempting to think you're earning incredible income. But often, a big chunk of that payout isn't earnings at all. It's your own investment being returned to you. Imagine owning a rental property where, instead of making money from rent, you slowly sell parts of the house to pay yourself. Over time, that erodes the value of the property. The same concept applies here. So who are these ETFs for? Picture 3 investors. The first is a retiree looking for steady cash flow and willing to accept some risk to generate income without selling core holdings. YieldMax could be an interesting addition, especially in a tax-advantaged account. The second is an active trader, someone who understands options and wants to use YieldMax ETFs as an income-generating engine while they deploy other strategies elsewhere. And the third is the long-term growth investor. For that person, YieldMax products probably aren't a fit. The capped upside and potential principal erosion work against a growth-first philosophy. Looking ahead, the future of YieldMax is going to be fascinating. As markets evolve and volatility shifts, we could see more niche ETFs, maybe tied to sectors like energy or AI, or even more complex strategies designed for high-frequency payouts. For investors, the key will always be education. Understanding what you own, why you own it, and what the risks are. Of course, with all of these ETFs, the risks are significant. Because they cap upside, you'll often underperform in strong bull markets. Many of the payouts you receive will be classified as return of capital, meaning you're essentially getting your own money back, which slowly reduces your investment base. There are also tax considerations. Frequent option-related distributions can be less tax-efficient in a taxable account. To wrap up, SLTY has offered steady but muted returns. RNTY and BRKC boast big yields but rely heavily on return of capital. And RBLX and DKNG are still in their infancy but show promise for income-focused investors. YieldMax's newest ETFs are bold, creative, and potentially useful tools, but they're not for everyone. Are they an income powerhouse or a risky trap? That's for you to decide based on your goals, risk tolerance, and strategy. Let me know what you think in the comments, and don't forget to like, subscribe, and share this video if you found it helpful.